Welcome back to Wall Street Podcast. Today we're doing a deep dive, really unpacking the latest on IT hardware spending. We're looking at a new report from Morgan Stanley.
That's right. The source is their 2Q25 CIO survey takeaways, hardware spend running in place. It just came out, published July 10th, 2025.
And our goal here is pretty straightforward. Pull out the crucial takeaways for you. We're focusing on North American IT hardware budgets, growth expectations, and what that really means for the market. Get you up to speed quickly.
Yep. And the survey itself, it's pretty solid. Based on phone and online interviews back in May and June, they talked to 100 enterprise IT decision makers.
Okay, 100 execs, mix of U.S. and Europe.
Yeah, 67 from the U.S., 33 from Europe.
Yeah.
And these aren't small shops companies from 500 million up to over 20 billion in revenue, across all sorts of sectors too. Finance, healthcare, manufacturing, tech, retail. Gives a really broad picture.
Good context. All right, let's get into it. What's the big headline number? What are CIOs saying about hardware spending growth for 2025?
Well, the headline is maybe a little underwhelming. They're expecting 1.5% year-over-year growth.
1.5%. And how does that compare to, say, last quarter's survey?
It's actually unchanged. Same number they gave in the 1Q25 survey.
Okay, so flat quarter over quarter. But I remember things were looking even more cautious earlier in the year.
That's true. It is an improvement from the 0.7% they expected back in late February, early March. So some upward movement there.
But still, 1.5%.
Yeah.
How does that stack up historically?
It's lagging. It's about 30 basis points below the 10-year average, which sits around 1.8%.
Okay. And compared to other tech segments, is hardware keeping pace?
That's the striking part. It's not. Hardware is actually the only tech end market where CIOs see growth decelerating year over year in 2025.
Really? Decelerating?
Yeah, it's lagging behind networking, communication services, software. Those are all expected to accelerate on average by about 13 basis points. Hardware's the odd one out here.
So the overall vibe is tepid. That's the word they used, right? Tepid, stable, but still pretty sensitive to policy and macro shocks.
Exactly. Leaves room for, potential volatility in the back half of the year. Things could shift.
Okay, so 1.5% overall. Is that the story across the board, or are there differences if you slice the data, say, by company size?
Yeah, there's a really important split here. It's not uniform at all.
Okay.
The large enterprises, we're talking companies over $10 billion in revenue, they're actually looking pretty robust. They expect hardware spending to accelerate by 90 basis points year over year.
Accelerate. To what level?
To 2.4% growth in 2025, so significantly stronger than the overall average.
That's a definite bright spot. What about the other end, small and medium businesses, SMBs?
They're interesting, too. Their spending intentions actually improved quite a bit, by a full percentage point just in the last quarter.
From what to what?
They were looking at a 0.2% decline last quarter. Now they're expecting positive time-out 9% growth, so a decent turnaround.
That's quite a swing. But SMBs are usually the most sensitive to macro issues, aren't they?
They are, absolutely. And the report links this uptick specifically to, and I quote, policy clarity post-Liberation Day. Seems like some recent policy announcements gave them a bit more confidence.
Interesting. So renewed confidence there, if that holds.
Right. If that confidence proves persistent, it could definitely be a tailwind, could lead to stronger outlooks later in 2025, maybe even into 2026. It's something to watch.
Okay, so we had this mix, large enterprise strength, potential SMB recovery, but overall caution. What are the main risks or headwinds CIOs are flagging? What projects are most likely to get cut if things get tough?
The number one culprit, no surprise, is macro uncertainty. Geopolitics, U.S. policy questions, interest rates, it all feeds in. And hardware budgets consistently come up as being particularly sensitive to these pressures.
And does that show up in project priorities? Are they shifting away from hardware?
We are seeing some of that. Things like storage hardware, desktops, laptops, general infrastructure hardware. They all saw a bit of a downtick in CIO priority this quarter.
Any hardware areas gaining priority?
Just one, actually. Server and mainframe projects saw a slight uptick. Everything else hardware-related was either flat or down in terms of priority.
And if budgets do get squeezed, what's on the chopping block first?
This is critical. Most CIOs view infrastructure-related projects as the least defensible IT projects right now.
Least defensible, so hardware is first in line for cuts.
It faces the highest risk, yes. If the macro environment gets worse or just more uncertain, Those hardware projects are the most vulnerable. That's a key takeaway.
And that caution seems reflected in overall budget revision sentiment, too.
It does. The report looks at the ratio of CIOs expecting budget increases versus decreases the up-to-down ratio. That downticked again for the second quarter in a row to 0.7x.
0.7, meaning more CIOs see budgets going down than up.
Essentially, yes. More are foreseeing downward revisions to their 2025 budgets than upward ones. It points to a tightening trend.
Okay, let's shift gears slightly. Generative AI, huge topic. How is that playing into the hardware spending picture? Is it taking money away from other hardware areas?
This is a really important finding in the survey. The answer seems to be a clear no. Gen AI is not cannibalizing existing hardware budgets.
Not at all. Where's the funding coming from then?
So 39% of CIOs said funding is coming from net new IT budget dollars. And crucially, 0 CIOs, literally none, expect the funding to come from their existing hardware budgets.
0. Wow, so it's genuinely incremental spending for hardware.
Exactly. It's an additive tailwind.
And how far along are these Gen AI projects? Are they driving spending now?
Some are. About 60% of these projects are either already in production or expected to be by the end of this year, 2025.
Okay, but that leaves a significant chunk for later.
Right. Over 30% are expected to come online specifically in 2026.
So the impact is more drawn out.
Precisely. The report calls it a longer-tailed opportunity for hardware spending. The real material impact from the AI infrastructure build-out is likely to be more significant in 2026 as more of those projects hit production.
Got it. Okay, let's bring this all together for investors. We have tepid overall growth, macro risks, but also large enterprise strength and this non-cannibalizing AI tailwind. How does this translate to stock views and valuations?
Well, valuations are, frankly, elevated. Hardware stocks are trading around 19 times PE. Relative to the S&P 500, that's about 0.87x.
And how does that compare historically?
It's high, nearly 1 standard deviation above the historical average relative PE.
And that seems disconnected from the CIO spending numbers we just discussed, that tepid 1.5% growth.
Exactly. The report notes this valuation level is not fully supported by positively inflecting CIO growth. And historically, that CIO growth number has been a really key leading indicator for positive earnings revisions and, stock performance.
So the fundamentals, according to the CIOs, aren't quite justifying the current market prices.
That's Morgan Stanley's read. They're saying they're incrementally more cautious on the hardware group overall, especially after the recent run-up in the market.
So where do they see opportunity within hardware then?
They still like names with specific drivers. Enterprise hardware stocks with clear AI and data center exposure, they mention STX, WDC, DELL, LTDC. Or, alternatively, stocks offering valuation protection or operating efficiency like SNX, CDW, KRNT.
And less keen on.
Less keen on the traditional OEMs and most consumer hardware names. Apple is noted as an exception there, but otherwise they prefer the enterprise and AI angles.
Makes sense. So what would need to happen for them to become less cautious on the group overall? What are the triggers?
They lay out 2 clear conditions. Either 1, a significant valuation derating, meaning stocks need to get cheaper. Or 2, more significant and persistent upward revisions to hardware budget growth expectations. Basically, the fundamental spending outlook needs to genuinely improve and stay improved to match the current valuations.
Okay, clear signals. So building on all that data, we've pulled out 3 key questions investors should be wrestling with. Let's tackle those. First up, we have this kind of conflicting picture, right? Tepid overall spend, macro risks looming. But then you've got strong large enterprise spending and this interesting SMB rebound. How should sophisticated investors weigh these different signals?
Yeah, it's definitely nuanced. That overall 1.5% figure, look, it is soft, it's below average, shows the macro sensitivity, no doubt about that.
But you can't just stop there.
Exactly. You have to look underneath. The divergence is key. Large enterprises are accelerating. That shows resilience in certain segments. And the SMB rebound, especially linking it to that policy clarity, that hints at maybe some underlying confidence returning. It could be a leading indicator itself.
So don't paint the whole sector with the same brush.
Absolutely not. It means you, as an investor, need to be selective. Focus on companies less exposed to those broad macro cuts, maybe those aligned with the large enterprise strength, or those positioned to benefit if that SMB recovery actually takes hold and continues. It's definitely not a monolithic market.
Okay, second question, focusing on AI. The report says Gen AI funding is mostly new money, not cannibalizing hardware budgets. How big is this incremental tailwind, and when does it really start moving the needle for hardware company revenues?
The non-cannibalization part is huge. Zero CIOs shifting funds from hardware to AI, that's a powerful signal. It means AI is truly additive demand for the hardware guys.
But is it a massive wave hitting right now?
It's a tailwind now for sure, but the survey suggests it's still early days for many of these deployments. Remember, 66% of projects are hitting production this year or later, and over 30% are specifically slated for 2026.
So the big revenue impact is still further out.
That's the implication. The material impact, the broad acceleration for the sector driven by AI infrastructure, that looks more like a 2026 story, maybe even beyond. It's a longer-term opportunity you need to factor into your models, not necessarily a huge boost to this year's numbers across the board.
All right, final question. Valuations. Hardware stocks are pricey, nearly one standard deviation above their average relative PE, even though the CIO spending plans are just okay.
Yeah.
What's driving that disconnect? And what specifically does Morgan Stanley need to see to get less cautious?
Yeah, the disconnect is striking. It's likely the market pricing in that future Gen AI tailwind we just talked about. Looking ahead, maybe putting a premium on specific enterprise strengths and sort of looking past the current, more modest spending growth figures.
So the market's optimistic maybe more than the current CIO budgets warrant.
That seems to be Morgan Stanley's view. There are caution flags that gap the gap between today's fundamentals, like that tepid CIO spend, which is usually a good forward indicator, and the elevated stock prices.
And the conditions for them to change their mind.
Very clear, laid out in the report. Two things. Either a significant valuation derating stocks need to come down, or more significant and persistent upward revisions to those hardware budget growth numbers. The fundamental spending picture needs to catch up convincingly to the valuations. It's basically saying either prices adjust down or fundamentals need to accelerate up.
That really crystallizes the current tension in the market. This deep dive into the Morgan Stanley survey, it certainly highlights that complex mix, the cautious present, some promising signals underneath, and this huge AI factor looming.
It really does. I think what stands out is that balancing act for investors, right? You have to navigate the current macro uncertainty, the risks there, but also position strategically for those future growth areas, especially in enterprise hardware and AI. It's dynamic. The details really, really matter here.
Absolutely. And maybe a final thought for you to consider as you process all this, how much of that future Gen AI hardware spending boom do you think the market has already baked into today's stock prices for 2025? Versus how much is still tied to that longer-term opportunity in 2026 and beyond, something to definitely mull over as you plan your next moves.